gold and silver prices are just going to keep going up. Why? Because the dollar is just going to keep going down. Powell just told you that, right? We're going to sacrifice the dollar. We don't care, right? We're cutting rates, even though inflation is above target. But more importantly, they're going to go to QE because what is going to happen? They're going to cut rates and long rates are going to go up. Then what? Because they want long rates to go down. That's the main goal. They want to get long-term interest rates down so the government, they think, can refinance the national debt at lower rates. They want to goose the housing market, right? Instead of doing the right thing by letting home prices go down, they want mortgage rates to go down so people can overpay for these homes.
Peter Schiff has been hammering the same message for years, and it now appears that the market is finally proving him right. Foreign central banks have already been pulling away from US dollars and treasuries, quietly but steadily rotating into gold. The Federal Reserve's policies are the accelerant. By holding rates low despite stubborn inflation and inevitably turning back to money printing, the Fed is sending one clear signal: the dollar is expendable. For central banks, that means the safer long-term play is gold, not paper claims on a currency that's being diluted. Schiff points out that retail investors haven't connected the dots. Many are still selling gold and silver because they believe prices are inflated, when in reality the rally is only just beginning. Gold is already up 28% this year, outpacing Bitcoin's 21%. Even the fastest horse narrative is lagging. The real shocker is in mining stocks. The big gold miner ETF, GDX, and the junior miners ETF, GDXJ, are both up nearly 80% in 2025. That makes them the single best performing sector in the market. And yet, you wouldn't know it if you watched mainstream financial media. CNBC, Fox Business, Bloomberg, every headline is about Bitcoin, MicroStrategy, or the same handful of tech giants. Hardly anyone is talking about the miners, even though they're minting money for investors. That silence is what Schiff calls a stealth bull market. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
The rotation that we've had, with foreign central banks out of dollars and out of treasuries into gold is going to accelerate as a result of this shift in Fed policy, right? Central banks are going to be more interested and more aggressive in their movement out of US dollars because the Fed has basically said, we are going to sacrifice the inflation side of the mandate because of the political pressure put on us by the Trump administration, which is still early days. We still got, 3.5 years left of Trump, and wait till Trump, gets complete control of the Fed. Wait till Powell is gone and some flunky has taken his place and they get some more FOMC members, right? He's going to completely have control of the Fed. And that means get rid of your dollars. That means buy gold. And again, it's not just central banks that should be doing that. Everybody should be doing that, right? Individuals should be doing that. They're not doing it yet. Again, I talk about the fact that at Schiff Gold, it's not like our phones are ringing off the hook. They should be, right? People should be calling in droves. We probably, we still get more people, I think, selling their gold and silver. They think they're getting a good price. They're getting a lousy price. Gold and silver prices are just going to keep going up. Why? Because the dollar is just going to keep going down. Powell just told you that, right? We're going to sacrifice the dollar. We don't care, right? We're cutting rates, even though inflation is above target. But more importantly, they're going to go to QE because what is going to happen? They're going to cut rates and long rates are going to go up. Then what? Because they want long rates to go down. That's the main goal. They want to get long-term interest rates down so the government, they think, can refinance the national debt at lower rates. They want to goose the housing market, right? Instead of doing the right thing by letting home prices go down, they want mortgage rates to go down so people can overpay for these homes. But when mortgage rates don't go down, then they're going to still want the Fed to bring them down. And how are they going to do that? Quantitative easing, where the Fed goes into the market and buys treasuries, or maybe starts buying the mortgage-backed securities again. They haven't been buying them at all. They've just been buying treasuries. In fact, they've been selling mortgage-backed securities as part of quantitative tightening. So obviously that's going to come to an end. I mean, that may come to an end in September. But there's going to be a lot of pressure on the Fed to resume quantitative easing in order to bring interest rates down. And that is going to bring the dollar way down. And you got to prepare for that. Look what happened to gold prices. Again, gold up. Gold is up 28% this year. It's a nice move, right? The year's not over yet. We're up 28% in the price of gold. Now, Bitcoin got all the headlines in 2025. That's all the financial community could talk about. Bitcoin is barely up. In fact, it's not even up 22% year to date. In fact, it was up 22% when I first started the podcast, but now it's dropped about $1,000. When I started doing this podcast about 40 minutes ago, and I looked at Bitcoin, it was 113,500, and it wasn't up 22% on the year. Now we're down 1,000. So Bitcoin isn't even up 21% now. It's at 112,500. So Bitcoin up 21% on the year. Gold up 28. Right? What I thought Bitcoin was supposed to be the fastest horse in the race. Right? That's what who said that? That was Paul Tudor Jones. Right? Oh, I'm buying Bitcoin. It's going to be the fastest horse in the race. Well, it's gold's got a nice lead this year on Bitcoin. In fact, I think they're sending Bitcoin back to the stable. In fact, eventually they're sending Bitcoin to the glue factory. But look at the gold and silver mining stocks. The GDX and the GDXJ were up 3 1/3% on the week. And the GDX and the GDXJ closed the week on new multi-year highs. I mean, maybe 12, 13-year highs. Year to date, the GDX is up 77.5%. And the GDXJ is up 78.5%. Those are huge returns. And, we're not even at the halfway mark for the third quarter. And we got those kind of returns. These gold stocks are on pace to more than double as a group in 2025. I said this when Donald Trump proclaimed that America was on the cusp or beginning, whatever, a new golden age. I said he means that literally. It's going to be a golden age for gold. And so far, gold is shining bright in the Trump presidency. But what's shining even brighter are the gold and silver mining stocks. So while everybody wanted to buy fool's gold and Bitcoin-related stocks, had they just bought gold stocks instead, they'd have made a lot more money. And in fact, even though gold and silver mining stocks are the best performing sector of the market, right? By far, there's not another sector that comes anywhere close, right? Precious metals mining stocks, hands down, the best performing group in the U.S. Why do they get no coverage? Turn on CNBC, turn on Fox Business. They don't talk about these stocks. I mean, maybe you get to Fast Money on CNBC and somebody will say, yeah, I like Barrick Gold. I like the GDX. Okay. Yeah. Someone will mention that like as a pick, but they really don't focus on it. Instead, they spend so much coverage on Bitcoin, right? And MicroStrategy. You're much better off on the gold stocks this year than MicroStrategy. Not even close. So this is a stealth bull market. No one is talking about it. The financial community isn't covering the story. You have the best performing sector in the market, and it's not even worthy of coverage as far as the media is concerned. They're missing the boat. People who rely on financial news are missing the boat, right? If you're watching my podcast, if you're relying on the Peter Schiff show, then hopefully you're not. Hopefully you're following my advice and you're buying gold and silver. And more particularly, you're buying the mining stocks because even though they're up 78% on the year, they're still cheap. That's how cheap they were before they went up. So there's plenty of time to buy these things. And the fact that the media hasn't even noticed it yet, that shows you how early we are. I mean, when did the media start talking about Bitcoin? Think about how much Bitcoin went up before CNBC finally jumped on the bandwagon, right? I mean, And so imagine where gold's going to have to be before we get a bunch of believers there. The tariffs are alienating us from the rest of the world. The tariffs are bringing our enemies closer together, right? If these are our enemies, but the tariffs are bringing China and India and Russia closer together, strengthening their trading relationships. China, meanwhile, is building up its relationships in Africa, building up its relationships in South America, even in Canada. Right? So we're actually improving China's trade relations with the rest of the world by trying to isolate them from the U.S. or jack up these tariffs. And we're doing the same thing with India. So all this stuff is going to backfire. And so all this is bad for the U.S. stock market. Meanwhile, look at Trump bragging about the U.S. government strong-arming Intel into giving up a 10% stake to the U.S. government, right? So the U.S. government, and Donald Trump is bragging about this, that the U.S. government didn't pay any money. And Intel just gave the U.S. government, gave it for free, 10% stake in the company. Now, why do you think Intel did that? I mean, did they just give the government 10% of their company? Of course not. We don't know what went on behind the scenes. We don't know what kind of pressure or extortion. Like, what did Trump say to Intel? Like, hey, this is what you need to do, or this is what we're going to do, or we'll do this, but only if you do this. Obviously, there was some kind of quid pro quo here. Intel didn't just give the U.S. government 10% of its business, right? For nothing.
Peter Schiff isn't letting the Fed off the hook for one of its most bizarre policy inventions, inflation averaging. When Jerome Powell first introduced it, the idea was that the Fed needed to let inflation run above 2% for a while to make up for the years it had been slightly below. The pitch sounded academic, but Schiff argues it was always nonsense. Nobody in the real world wanted higher prices just so the Fed's chart could average out. It was a convenient excuse not to raise rates when they should have. And here's where Schiff really drills in. If the Fed were genuinely serious about averaging, then after several years of inflation running well above 2%, logic says they should now aim for inflation below 2% to balance it out. But that's not happening. The Fed never meant average, they only used the framing when it justified looser policy and higher inflation. Now Powell has dropped the talk of averaging altogether, insisting the goal is to bring inflation back to 2%. Yet even that isn't happening. Inflation remains too high, continuing to erode real wages and purchasing power. Despite this, the Fed is preparing to cut rates. Schiff warns that if inflation is already too high before rate cuts, it will only accelerate once monetary policy loosens again. Let's get back to the interview.
When Powell first announced inflation averaging, he said that we needed to target inflation of a little bit above 2% because we had to make up for, the years that we were below 2%. Which I thought was a bunch of nonsense. I mean, what Powell was saying is, hey, prices only went up by, 1.5% or something like that in the past year. And so we didn't get enough inflation. We needed more. Prices didn't go up as much as we wanted. And so therefore, we have to make sure that prices go up more than 2% the following year so we can average it up to 2%, right? Like that was really a problem. Do you think Americans were sitting back saying, God, I didn't just get enough inflation last year. The prices of the things that I need didn't go up as much as the Fed wanted them to go up. So I really need the Fed. I really want the Fed to help make up for that because I feel like I got cheated out of some inflation. I was really hoping that I had enough inflation to hit the Fed's goal. And, I feel like I got shortchanged because my prices were just not high enough. I really want to make sure that next year they go up by more than the Fed's target. That way I get some extra inflation to make up for the inflation I got cheated out of, right? You think anybody was thinking that, this, like the biggest problem people had in America was making up for the fact that their cost of living didn't go up enough in the previous years. And we needed the Fed to save us from the horror of this by letting us have some extra inflation this year, right? So I said at the time that it was all a bunch of BS, that the Fed was just looking for an excuse not to hike, right? And so they made up this nonsense about inflation averaging. Well, for the past several years, I've been pointing this out, and I've been saying, well, when are they going to target inflation below 2%? Because aren't we going to average down all this high inflation? right? If we had to average up to low inflation by targeting an inflation rate above 2%, don't we also have to average down high inflation? Don't we need to target less than 2% to make up for all the years that it was above? In fact, if you go back to the 5 years prior to 2021, right, when the Fed, rolled out this nonsense policy, right? The only year, or there were 2 years in the previous 5 where inflation was below 2%. There was 2020 when it was 1.4. And then there was 2018 when it was 1.9. Man, we really got cheated in 2018. We only had 1.9 instead of 2. We really need to make up for that. But that was 2018. 2019, it was 2.3. 2017, it was 2.1. 2016, it was 2.1. Almost bang on 2%. In fact, if you average the 5 years from 2020 to 2016, the last 5 years, the average rate of inflation was 2%. The Fed nailed it, right? Imagine that, right? So there was no lack of inflation that we needed to make up for. Yet the Fed said we needed to make up for it anyway. Now, the reason that Powell gave for giving it up is he basically said, look, we tried it. We tried to overshoot a little bit, and it didn't really work out for us. Meaning, yeah, we tried to overshoot by a little bit, and we did it by a mile, right? They went for 2.1, 2.2, and they got 9.1, right? So, yeah, they tried to overshoot a little bit, and they overshot by a mile. So they said, that's why we're giving it up. But the real reason they're giving it up is because there is no way to average down 4 years of inflation that is double or triple 2%, right? Because they would have to average way below, probably 0.5% for many, many years in order to create an average of 2. But the Fed never wants inflation to be below 2%. It was only willing to have it be above 2% to average inflation up. But there's no way, and I said this, they're ever going to try to average inflation down. And I was waiting for somebody in a press conference to call Powell out and say, hey, what about your goal to have an average inflation rate of 2%? How are you going to achieve that goal now when inflation has been so much above 2% for so long? Well, now they don't have to achieve that goal because they finally abandoned it. They finally admitted that there is no more goal of having an average rate of inflation of 2%. They're just trying to bring the rate down to 2%. But that's not going to happen. It's not going to be 2% this year. It's not going to be 2% next year because they admitted that inflation is too high and they're about to cut rates. So if inflation was too high before they cut rates, it's going to be even higher after the Fed stopped short of being restrictive. And although maybe the minute they saw that policy was restrictive, they backed away because Signature Valley Bank and a couple of other banks failed, right? 3 banks failed. And then the Fed stopped hiking rates. So they never got to restrictive territory because credit never stopped expanding, right? Inflation is an expansion of the supply of money and credit, right? I've talked about that. Credit is very important because you don't need money to buy stuff. You can buy stuff with credit, right? And so if you can bid up prices with credit without having any money, and we've raised that to an art form in America. Well, expanding credit is inflation. You've got more credit available to buy goods. And even though the Fed was hiking, the hikes were never substantial enough to restrict the credit growth. Americans didn't stop spending money. They didn't stop borrowing money because rates got too high. Nobody said, interest on the credit card is just too high. I better not use my credit card. I better stop buying things on credit. No, they kept on doing it. They didn't pull back. The government certainly didn't pull back. The government didn't say, interest rates have gone up. We better borrow less money. We better cut our spending and balance the budget because we don't want to have to pay these higher rates. No, they just kept on borrowing and spending, paying no attention at all to the rate hikes because they were too little, too late to make a difference. The Fed never got to restrictive territory. Not even close to restrictive territory. People talk a lot about Volcker days and the fact that interest rates got to 20% under Volcker. Well, inflation never got anywhere near 20%. I mean, it did get to maybe 10, 11%, at its peak. But other years, maybe 7 or 8%. I mean, so you had a Fed funds rate that was more than double the inflation rate. Not quite triple, but that was restrictive. Now, we never got anywhere near there. I mean, our inflation peaked out at 9.1, but the Fed basically peaked at interest rates at about 5.25. So our interest rates peaked at half the inflation rate, not twice the inflation rate. And of course, we didn't even measure inflation. If we measured inflation now, the way it was measured in the 1970s, we didn't peak at 9%. We probably peaked at 18%. We probably had a higher peak during this cycle, which hasn't even finished yet. We're still playing it out. But we probably had higher inflation than the peak of the 1970s. But interest rates this cycle didn't even come close to what we got back then. So we never made it into restrictive territory.
What becomes impossible to ignore is that policy credibility is unraveling in plain sight. Central banks abroad are signaling, through their actions rather than their words, that they no longer trust the dollar's trajectory. At the same time, investors at home are being lulled into complacency by headlines that miss the real story. Mining shares are screaming strength, yet the spotlight stays fixed on tech and crypto. At the same time, the Federal Reserve continues to twist its own rulebook, redefining goals when convenient and abandoning them when they no longer serve. That leaves markets in a precarious position, where the narrative of control remains intact, but the underlying stability is eroding. If the tide entirely turns, the repricing of both money and assets could be far more violent than most expect. Will the eventual reckoning come gradually as confidence erodes step by step, or will it break suddenly once the illusion of monetary discipline collapses? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.